Brace yourselves. The hard market is coming. Insurance rates high enough to cover the risk. Insureds forced to practice active risk prevention agencies. Building even stronger Wait, this hard market thing, it's bad, right? Or good? What are we supposed to do with it again? Let's circle back and talk through this. The property casualty insurance industry has been in a soft market for the last 7 years. Sunshine, puppies, low premiums, loose underwriting guidelines, but all of that is about to change. The hard market is coming. So what is a hard insurance market? All industries experience cycles of expansion and contraction, and insurance is no exception. Insurance cycles typically last 2 to 10 years and include a hard market and a soft market. The characteristics of a soft market include lower insurance premiums, broader coverage, relaxed underwriting criteria, increased capacity, i.e. more policies and higher limits, and increased competition among insurance carriers. On the other hand, the characteristics of a hard market include increased insurance premiums, more stringent underwriting criteria, reduced capacity, and less competition among insurance carriers. The last hard market in 2012 was exacerbated by cat claims and an economic downturn. Most people in the general public have this idea of insurance companies being these mega rich cash hoarding behemoths. But as most on the carrier side will tell you, this is not typically the case. It's generally more of a paycheck to paycheck style living. For the first half of 2019, the average P&C combined ratio was 97.3, which is not bad for the insurance industry. But how many other industries survive on profit margins this low? So when interest rates plummet and all of a sudden all of that premium that carriers are investing is returning half of what it did last year, that's a big problem for them. They have to make up that money in other ways, which is not that easy when you're already operating around 100% combined ratio, aka barely breaking even. This conundrum played out very vividly in 2012, 2013 in areas like wildfire coverage. Between the cat losses and the overall drive to reduce risk, underwriting guidelines snapped shut basically overnight. I had a friend in Colorado get a non-renewal letter for her home policy in which the reason cited was tree within 100 feet of premises. That was not a one-off either. I saw several carriers hightailing out of that area and many others. And carriers that did stick around reduced coverage and raised rates. And while insureds may not be familiar with our terms like hard market, they definitely feel it. When your home policy renewal comes through and you see your premium double and your roof coverage switch from RCV to ACV, you don't need a CPCU to know that is not an upgrade. But I do think the hard market gets too much of a bad rap. Here's where I see an upside. Soft markets invite competition and lots of it. That means premium reductions and the increasing commoditization of insurance. And here's where I'm going to do my best Bill Wilson impersonation and say that insurance is not and should not be a commodity. R to the T to the F to the P. Hard markets reduce the churn and burn of high shopping rates and all that goes with it. A vintage Insurance Journal article from 2006 highlighted this, saying that it's much harder for agents to thrive during market cycles when they switch from carrier to carrier chasing lower prices. They end up working twice as hard for less money. Hard markets also bring more sustainable rates. Property Casualty 360 reported that in Q4 2019, personal lines rates were up 4.5% and commercial lines rates up 5%. I think we'll see this continue in 2020, particularly for commercial lines. Increasing premiums are never fun to receive as an insured, But when they are done because they are necessary. Mohit Pan, Swiss Re's US and Canada head of underwriting for property, hit the nail on the head in an interview on the hard market with Insurance Business Canada. He said, "The thing is, it's coming after some years of rate decline, so I think it's quite important that it continues that way. The discipline around pricing, capacity, deployment, and terms and conditions has to stay for a bit so that it can catch up with the loss trends and also fill that gap in profitability. Low premiums and fast-paced growth is great in the short term, but often catches up with you eventually. You can't operate on an 80% loss ratio and stay in business. And nobody wants insurance companies going under or shutting down states. That's just across the board very bad. So sustainable rates are good. But the hard market characteristic that does concern me is when coverage gets so reduced and underwriting guidelines so tight that large groups of risks become uninsurable. Let's not do that. Carrier friends, remember there is no bad risk, just bad rates. Price for it. Add some risk sharing and loss prevention mechanisms. But let's keep insuring the risks that need insurance. Agencies could use your help here as well, especially on the commercial line side. The harder the market gets, the more you'll really need to partner with your insureds and underwriting to get both new business and renewals done. I'll link in the description box to some posts and articles that cover that aspect in more detail. The question for you is, what will this hard market look like? A lot has changed since the last hard market. The economy, the political environment, the insurtech movement. There's been a lot of change. Will this hard market still look like prior hard markets? Do you think it'll be a shorter hard market or hard market light? Let me know in the comments, and don't forget to subscribe to the Insurance Nerdery, where it is cool to be a nerd. I'll see you next time.